there's always that excitement about the possibility of getting rich and getting rich quick. One more book, if I read one more book, look at one more website, read one more thing, I'm going to find the secret.
Everything you've described, you could have just been talking about YouTube right now, and nothing has changed in the 300 years.
It isn't to say that it's all the same. It isn't to say that it's all a scam. That's the closest we've come to kind of, figuring out, well, we can't beat the market, but maybe we don't have to.
So today we're joined by James Taylor, who is the Professor of Modern British History at the University of Lancaster. You're also the co-author of a book called Invested, How 3 Centuries of Stock Market Advice Reshaped Our Money, Markets and Mind. And that's really what we're going to talk about today. I think this is going to be fascinating because what you've done is you've looked at the history of modern advice around beating the market essentially and how that shaped over time. And I think by exploring those themes, we can get a lot of answers on who we should listen to and, why advice might not always be what people think it is. But I also think there's loads of parallels to what I do in YouTube, and I want to explore those as well, because as I was reading the book, I was just like, oh my God, this is just exactly YouTube now. It's crazy. Yeah. Could we just start with what prompted you and your co-authors to write the book?
No one's really written about this subject from an academic point of view before, certainly not kind of covering 3 centuries. So there'd been a bit of academic literature kind of looking at aspects of this story, but no one had really thought about stock market advice literature as a genre like any other genre, like fiction. I mean, that might be a particularly relevant parallel that we can explore later. But kind of thinking about how this genre develops over time, a genre that has its own rules and conventions, and trying to understand the influence that that's had on ordinary people's lives in Britain, but also in America over a very long period of time.
And this is specific, like you say, like as a genre, this is a genre of literature. This could be a publication, a poster, it could be a book, but it's basically, I have the answer to the stock market, consume my content. It's that sort of message. And when did you first see these sorts of messages pop up?
We wanted to start with the South Sea bubble and kind of this famous stock market crash of 1720 that is often referred back to as kind of being a paradigm of how stock market over-exuberance kind of develops and then has very unfortunate results for people. But we actually ended up looking even before that and looking at the very earliest texts that kind of talk about the stock market and help people understand what the stock market is. And one of our arguments is that it's kind of the literature creates the market in lots of interesting ways, because without people writing about it, you don't have any capacity for the population as a whole to be involved, to be invested in the market. So the print culture kind of creates that market. So we were looking at all the early genres of writing that kind of feed into popular understanding of the stock market, but also thinking about kind of this idea of getting rich quick, because that's the cliche, isn't it? That anyone who's advising you about the stock market is kind of promising you or the road to riches, shortcuts to wealth. And we actually found that goes back even further to kind of the early mid 17th century. So long before the stock market even exists, we were finding kind of self-help books, as we would call them now, before that term existed. But texts like The Pleasant Art of Money Catching and things like this,
which
it's just a brilliant, it just sums it up. Yeah. And that was first published in kind of, 1680s, I think that one was. And there's all these other texts that are promising people, how to get rich quick. And they're not talking about the stock market, but it's interesting when you read them, all the kind of tropes, all the ideas are the ideas that we'll subsequently find when we look at people who are talking about the stock market, are trying to get people invested. But I think the real kind of first iconic text, which is a recognizable manual to how to act on the stock exchange, is Thomas Mortimer's 1761 book, Every Man His Own Broker. And I mean, there are interesting kind of assumptions going on in that title, which we can look at. But he's someone who was quite well born, a gentleman, and kind of he found his way into the early stock market. So this is before we have a stock exchange as such, but stock trading happened in the alleyways around all the coffee shops in what's now the City of London. So Exchange Alley was the big location where people would be trading shares, nip into the coffee shops. That's where all the brokers and the jobbers would hang out. So there's not one actual stock exchange, but the trading took place there. So Mortimer was a guy who ended up there basically to get rich. I've heard about the stock market. I've read about it in newspapers. This is where I'm going to go. I'm going to make my fortune. He lost a fortune instead and blamed all the intermediaries, blamed the stockbrokers, the stock jobbers, said, I've been defrauded, I've been fleeced. I'm going to write a book to help other people make money rather than lose money through being kind of defrauded, essentially. So his book is the first kind of how-to manual, which is giving a lot of advice about literally how to behave in Exchange Alley and in the coffee shops, how to buy and sell shares. And his big message was basically cut out the middleman, that the brokers and the jobbers aren't to be trusted. You've got to do it yourself. And if you go to the coffee shops, you can find buyers, you can find sellers, you can transact all your business yourself. And he actually sets himself up as an expert who will literally kind of hold your hand. You buy his book, and if that's not enough, you can go and
He'll
get
be a middleman for you.
This is the first of the many contradictions that we find.
I saw that through your work. It's beautiful. Another contradiction, his title, Every Man His Own Broker, as long as that man isn't black, Jewish, or a female. Because he was anti-Semitic, racist, and didn't like women very much either.
So this is a characteristic of a lot of this literature, and that goes on a lot later than you would think. Because you might think, 18th century, this is to be expected, but it kind of remains there, and it is still a thing. But it was so revealing that already by this point, the ledgers show that thousands of women were investing in government bonds. Women were a presence in this very early stock market. But insofar as he talks about women at all, he's basically saying, surely you've got a male relative, brother, a father, someone who can do this for you. He does not trust women to go into the coffee houses themselves. So his guide is kind of entrenching all these assumptions. And there's this very strong sort of strand of anti-Semitism that runs through it, because a lot of the early brokers and jobbers, a definite minority, but they are Jewish. And so there's all these anti-Semitic ideas.
Because he's lost money at their hands, he sees it as, and blames them.
And that persists as well.
Fear persists, right? Even in modern times, they sell under a guise of, this is very complicated, it's very scary, and if you do it wrong, it will destroy your life, kind of thing. It's always got that message, it seems, from your research.
It's absolutely, that's all there in this guide by Thomas Mortimer, that, he has these very colourful passages. One of the fascinating things about this text, when you read it, it kind of alternates between fairly dry and descriptive kind of details of, this is how you go about buying and selling a share, because you're cutting out the middleman, so you need to know the technicalities of, the paperwork that's involved. But then he'll just veer off into this flowery description of, that's influenced by almost sort of apocalyptic writing of kind of bemoaning the evils. The stock exchanges are hell, the people there are devils, and it's this kind of very lurid picture that is meant to kind of make you think, oh wow, this is a scary place.
I need an expert.
I need an expert. So that's such a trend running through this literature, kind of build up excitement and interest, but also a bit of fear and a bit of apprehension. Therefore, you need the expert.
Yeah, I did. And it was interesting to see how a lot of these experts, you call them outsiders. So the insiders within the professions, the people who were, maybe this was later on once the stock market became more established, but the people with the actual knowledge rarely shared that information because they wanted to, maybe there was conflict there or they didn't want to. And what you actually get is unprofessional outsiders that were the ones writing the literature.
I think, there's a big element of that. The stock exchange, the first time there's a building with stock exchange written over the door, that's 1773, and then it becomes a kind of members-only club at the turn of the century, so 1801, 1802. And from that point, it becomes this kind of mysterious place. If you're an outsider, you literally can't enter the building. So there's all this mystique about the stock exchange. But at the same time, the actual members of the stock exchange, they're kind of quite affluent, quite well-to-do. They're not that interested in small investors.
Certainly not helping them.
Yeah, because they're making money from the commission, and they're not going to make much money from someone who's got a few pounds to invest in the stock market. So that's where you get this outside class of stockbroker who in the 19th century, there's no rules against them advertising. So if you open a 19th century newspaper, you're going to see their ads, quite sensationalist ads, the whole get rich quick, invest with me, you will make money. And they're the ones who are leading the way in kind of popularizing financial advice in the generations after Thomas Mortimer. So it's the outsiders who've got a vested interest in building the market, broadening the shareholder base. The insiders are quite happy keeping the market kind of small and manageable. The outside stockbrokers are very happy to bring in new people. So they're the kind of democratizers of the market in the 19th century.
I hope people can see the parallel between modern day finance, where people who are regulated and authorized, say, by the FCA, they won't talk about finance because there's just too much risk there, not much reward. Whereas YouTube and things like this is where most people are seeking out their financial education, and they tend to be unregulated outsiders that are commenting on it's the exact same thing.
Exactly.
It's kind of mad how these things just keep repeating themselves.
Yeah.
One thing that also struck me was you would have these like pseudo celebrities like Mortimer, and there's other people, and a lot of them, they just had very simple messages, but these are like key. Diversification was one guy who came forward, sold a message of diversification, but then actually took his clients' money and lost it all through lack of diversification.
Yeah. It's so fascinating to kind of trace the development of ideas, and particularly ideas that are very recognizable today. It's a key principle of investment, of course, diversification, but we're tracing the kind of early origins of it. Whereas, Thomas Mortimer's not that interested in diversification. His message is very simple. You put money in the government stock, the government bonds, you invest in your country, patriotic investment. You leave your money there because you don't want to kind of give more commissions to the stockbrokers, and you'll do fine in the long term. So it's kind of what we would call buy and hold strategy, very, very simple. But then in the 19th century, you get a whole range of new companies, the real booming economy of the Victorian age, particularly imperial expansion as well, companies set up for imperial development. So you get the railway boom as well, telegraph boom, new technologies. So you get these huge diversifications of stocks, and that creates the idea, well, maybe there are opportunities here to actually, is expressed in the very earliest literatures, don't put all your eggs in one basket. So a kind of phrase that pre-exists stock market advice, but it's harnessed in a very basic way in the early periods or mid-19th century. But then later 19th century, you begin to get the origins of people thinking a bit more scientifically. They said it's debatable how scientific it is. It's kind of maybe by the standards of the day. But someone like Henry Lowenfeld in particular was a pioneer of the geographic distribution of capital. That was his kind of big sales pitch. His idea was he divided up the country into like 10 sectors basically, and you've got to spread your capital across the globe. And there's a lot of sense in that from a basic economic perspective. But yeah, it's like he's one of the many financial advisors who's found to have been slightly more kind of compromised than we might think. Academics tend to just pick up on his ideas about the geographic diversification of capital. But if you dig a bit deeper, one of his big services was send me details of your portfolio and I'll manage your portfolio for you if you don't know how to diversify your capital. This became quite a big scandal because he was accused of taking people's lists, telling them to sell all the good ones, and then he would flog them other stock, which maybe its long-term prospects were not quite so good.
Pioneer in a way, and also a fraudster, which I heard you speaking in like an interview or a presentation where you said, because your background is fraud, right? Mm-hmm. And you were like, I was ready to be done with fraud, and I stepped into the world of financial advice and realized it was riddled with it.
Yeah.
The whole thing is people just with self-interest. Mm-hmm. And the quote in the book, which it still stands again today with financial YouTube, is there's a lot more money to be made talking about investing than there ever is to be made from investing.
I think we see that even going, to Thomas Mortimer is one of our sort of touchstones, and you could say it's even present there because he admitted he'd lost a lot of money through investing. He certainly made a lot of money writing books about investment. He claimed to have sold upwards of 50,000 copies, which at a time where, the market for books like that is a lot smaller than it was to become. It's a large number. It went through over a dozen editions. It was still in print in the early 19th century. So it had like a 50-year shelf life. Not many books can claim that. And so he's making money through kind of not playing the market successfully, but through, selling services, selling advice that will help others to do so. At least that's the pitch.
What you would think is, why would people buy his book? I mean, if it's like Warren Buffett writes a book, okay, he's a successful investor. Damien has a YouTube channel, but he's done a lot of research. He understands finance. He knows what he's talking about. Why would people buy a book? And the same today, like with YouTubers, why do people trust people so much that haven't proven that they're like an amazing investor or they've made loads of money from investing?
That's one of the big questions that we faced with our research. I mean, trust building strategies are really diverse through this period, and there's not one consistent pitch. So sometimes they build this celebrity persona, and through our period that becomes more and more and more common. And so by the late 20th century already, the market is full of kind of celebrity financial gurus, and their brand is a huge part of the sales pitch. And you see elements of that in the earlier period, but quite a lot of the texts we look at are anonymous. So there's no name attached.
Really?
Yeah, there's no kind of, I'm an expert, I can explain this, but look at my track record. It's just this anonymous circulation of kind of purported information and expert advice. That is just, the expertise is created rhetorically through the text itself. So you read it, you become convinced because they clearly know more than you. They've written this book, they've published it. Perhaps it's, to some extent, it's the kind of the guarantee of quality given by the publisher, because there are a lot of big London publishers involved in this. But nevertheless, these aren't celebrity experts. These are just anonymous texts in many cases. I think it's even more interesting when it's these outside stockbrokers that are circulating these materials, because they're often circulating it for free. You don't have to pay for this. They're using the postal system to send thousands of circulars and pamphlets out for free. And you would think in hindsight that it would occur to people to question their economic motives. It's like, why is this free? Is there a catch? Is there something going on here? But that authority is just a kind of abstract kind of the authority of the text, the authority of the repetition of certain ideas across dozens and then eventually hundreds of texts. And as I said, whenever you open a paper, all those ads there, and they kind of almost becomes an echo chamber kind of effect that you keep seeing these promises. They're appearing in the Times newspaper or the Manchester Guardian, whatever it might be. So surely it's got some reputability to it. There must be something in it. These adverts keep appearing. So even though they're not often attached to a kind of celebrity expert, the Warren Buffett kind of idea, people believe this stuff.
The same with crypto, right?
Yeah.
Crypto came about and people saw people getting rich and they thought, well, that can happen then because we know that. And then they're going on the tube and they're seeing adverts for Flocky Inu on the tube. And they're thinking, well, if the London Underground's advertising it must be legitimate.
And they're seeing it all over social media, on Instagram,
and then
on
there's
LinkedIn.
someone like me talking about it. And it's just like, it's been waved around in your face the whole time. You start to believe it's real.
Mm. Well, there are interesting parallels because around the time that this is developing this kind of sales technique in the 19th century, one of the biggest consumer products is patent medicines. This is before the NHS. You've got a lot of illness before all kinds of scientific discoveries, penicillin. People are basically ill. A lot of the time people are unwell. And you get all these vendors of patent medicines, the snake oil salesman, exactly. And I think it's not a coincidence that if you look at a 19th century paper, the outside brokerages are literally often advertising next to the latest snake oil remedy. And so it's kind of this idea that they're almost feeding off each other, people's hopes, people's desperation, people's lack of knowledge, people's lack of
and we can fix that with call this and that. People want to believe that there's easy answers to complicated problems, don't they? And I think anyone who promises that will get traction if they're convincing.
And I guess they reinforce each other. Like all the adverts in the different papers, they're not conflicting adverts. They're all kind of saying, get into the stock market, you can make loads of money. So every advert they see and everything they hear is reinforcing the initial idea they first heard, right?
And so as time goes on, they kind of get more sophisticated because there are a lot of people getting burned. There are a lot of people losing money. And the ads begin to acknowledge that and kind of pointing the finger at other brokerages or other advisors saying, don't do business with them. Don't believe everything you read in the paper. Believe us. So it's a kind of this economy where don't trust the others, but you can trust us. And it might seem like a transparent strategy, but that works as well.
So there's an element of survivorship bias that I see online where it's like, I bought Tesla at 100 and it's now worth 1,000, so I know what I'm doing. Whereas actually you're just the one example of the guy who did that. Like you just so happened to buy it. And now they're selling courses on how to buy the next Tesla and things like this. Like people who bought Bitcoin. A guy might have been buying a bag of weed online and bought 100 Bitcoin at the time and forgot about it. And now he's worth loads, but he's now a crypto trader. Do you know what I mean? And it's like, how many of these people are just lucky or like you say, and they get there and then they tear down other people's reputations and it's just survivorship bias in this publication. One thing that I found really interesting from your research though was not the fact that it's all just about making money, but that it quickly became apparent that a lot of it was about entertainment and that people kind of enjoyed the consumption, like armchair traders and things like this that never actually did it.
I think so. I think that's a huge element in it. And that's built into the genre that occasionally the authors will make references to the idea that, well, you may not actually do any of this, but it's useful to know, or it's fun to kind of think about it or imagine it or fantasize about it. So there's a real kind of, particularly in the 19th century, the stock market is a big deal. It's growing, but the proportion of the public that's invested in the market is still, by today's standards, quite small. So I think there's an acknowledgement quite early on that, and a kind of pitch to the general public that it's exciting. This is a form of entertainment. There are thrills to be gained from speculation itself, but there are also thrills to be gained from reading about speculation, reading about big stock market crashes. So in the fiction of the 19th century, it's a very common strategy to talk about a big stock market fraud, swindle, crash. It's there in all the kind of big name authors that we remember today. Charles Dickens writes about it. And I think that's kind of laying the groundwork in some ways, because before people can invest, before people have the money to invest, they need to understand the stock market. They need to have ideas about it. So there's a real sense that even if it's a bit disreputable, even if it's riddled with fraud, it's still really exciting. And, this is a place where there's always that excitement about the possibility of getting rich and getting rich quick. And I think in a kind of, by the later 19th century, the writers begin to acknowledge that for those who are investing, those who are speculating, maybe the payoff isn't just financial, that part of the reason for doing this is the fun and the excitement, and that's part of what they're selling as well. And then it begins to get into kind of really interesting self-help territory, because self-help literature, self-improvement literature is all about the self, and thinking about, how can I improve myself? How can I become a better person? How can I transform myself? I'm not happy with how I am. I want to become better at X, Y, or Z. And that's sort of the key change that we identify around sort of late 19th, early 20th century. It becomes one of the big pitches of the genre. And I think it's never gone away.
That's still today, right?
Yeah. And I think it's kind of, on one level, it's, that's fine to acknowledge that there's a thrill element to the stock market. Well, of course there is, that thrill of seeing the prices go up and down. But it's interesting in how it features in the advice literature that it comes wrapped up in a whole bunch of assumptions and a whole set of ideas about identity, that these texts are always written, nearly always explicitly, for white middle-class men. Basically, that's the market. And when they talk about the investor, when they address the investor, as they often do, and they refer to you, it's with all the kind of cultural assumptions that come with talking to white middle-class men. And then it increasingly becomes about modern definitions of masculinity, and you define yourself as a white middle-class man through your actions on the stock market. Right. Because to become a successful trader, the market, when they talk about the market, they imagine the market as kind of feminized. This is in crowd psychology as it develops through the later 19th century, when people start talking about the crowd. Modern urban society, you've got a lot of crowds. You don't have crowds in rural society so much, but when you've got these big towns and cities, you see lots of crowds. And the stock market is the kind of abstract crowd of thousands and then millions of investors. And that's always constructed as feminine. And the role of the individual trader is masculine, is to master the market, the feminized market. So they're all kinds
almost like cars are always women, or whatever. Yeah.
So you need a strong masculine man to tame the market, the female, and seduce the market of the feminine.
Even though it's all a collection of white men, they feminize it. Yeah. Your mastery over the market. Yeah.
Yeah. So key to succeeding is to master any sort of feminized tendencies that you might have, or any weakness. So emotion. We'll have emotions, but emotion is kind of stigmatized in these texts as you need to drive out all emotion and human sympathy, because the only way you're going to master the market is to not be driven by your emotions. They're all driven by their emotions. That's why you get the runs on the market, the rest of it, because people are driven by emotion, greed, fear. You've got to let go of all of that. So it's mastery of the self.
The future.
The past.
Being late for a train.
You being late to pretty much everything.
The things that make us anxious are pretty ridiculous.
Our standard of living has improved so much over the last 100 years, but are we less anxious?
Oh no, I'm pretty chill. But if you do suffer from anxiety, check out our partner Sensate.
I've been using their device and it has been helping me. It's shaped like a pebble and it vibrates to help calm your vagus nerve. I just pop it on my chest for 10 minutes if I'm stressing and it settles me right down.
Plus, our listeners can get 10% off with the code MM10. That's MM10, and there's a link in the description.
The idea that it's tied up in your identity of self, did you see that shift at all? Did you see like in the 60s it became more inclusive, or is it still like that now?
There are shifts. One of the big sort of stories that we trace is kind of, well, how are women eventually incorporated, like not so much into the market, because they're always there. You go back to the 18th century, they're there. They're providing capital. They're always a presence on the market. But rhetorically, they're always excluded. So you don't see them in the pages of the texts. Big turning point in the 1860s. 1863 is the first text written for financial advice for a female audience. So it's written anonymously by a banker's daughter. So we later know that it's Emma Sophia Galton, who is a daughter of a Birmingham banker. And so she kickstarts this trend of writing for women, of rhetorically recognizing that women are part of this market and addressing women's concerns, women's priorities, and how to navigate the market as a woman. But it takes such a long time for the figure of the public, a female financial expert, to kind of arrive on the scene. And they're always in a minority, and a lot of the kind of textual constructions of the investor are still hypermasculinized. I mean, there are lots of examples of it today. A lot of the rhetoric around speculation is very hypermasculine. You move into the 1980s, by which point, women have been allowed onto London Stock Exchange. You would imagine that the kind of macho financial culture would be fading, particularly with the decline of the trading floor for a lot of securities around Big Bang and the rest of it. But of course, that's the kind of, it reaches a new level of hypermasculinity with Wall Street, greed is good, the kind of language.
Gordon Gekko kind of, the 80s, and even Bull and Bear are very masculine images, aren't they? Or like big power, like the slang around the markets, like you say, is very aggressive, masculine. One thing that made me think from the research that you did is even books that are celebrated today are born out of the same kind of world. So to talk about Benjamin Graham and the creation of almost value investing off the back of technical analysis collapsing, people reading charts or whatever. And out of that, it was like, let's go to value in businesses. And this is still logic now that holds up. Warren Buffett, Charlie Munger, arguably some of the greatest investors ever, still celebrated today, but they show all of the hallmarks of these other types of literature that we're laughing at as scams. It's the same stuff.
Yeah. Well, that's one of the benefits of studying this as a sort of genre of writing. And you see all these connections and overlaps and kind of replications of history. And it isn't to say that it's all the same. It isn't to say that it's all a scam. No. And you have to distinguish between, I guess one of the fundamental distinctions is between a how-to literature, which is kind of basically just explaining what it is and how you do it, but is not making you any massive promises. And then there's the how to win or how to succeed literature, which is going for, it's not just telling you how to do it, but promising you that you're going to win. And kind of that distinction was coined back with the novelist G.K. Chesterton coined that like a century ago when he was looking at success literature. And I think it's a useful distinction. And so there's obviously a lot of good work in this field of people that are not overselling and not promising you the earth. I'm not saying you'll get rich with doing very little work, making very little effort, but all the kind of tropes and ideas are still embedded in this literature. And it's why people keep reading it, is because one more book, if I read one more book, look at one more website, read one more thing, I'm going to find the secret. And it is just this lure of the insiders telling the outsiders, look, I'm going to share with you the secrets. It's fascinating to look at how kind of in the 1980s, I mean, this is history now, but when all the public utilities were being sold, British Gas, Telsyd, the advertising campaign around that, how it's being sold. This is a state that's deciding to privatize public utilities, but the way that's sold to the average investor is in the form of like an inside tip, like Telsyd, this is a secret, I'll get you in on the deal. So even the state is kind of borrowing some of these techniques about, I'll put you on the inside, I'll put you onto a good thing, I'll share with you the secret that will make you easy money. And so the ideas, the lure, the appeal is rife. It is throughout. It kind of defines the genre, and it makes sure that people still want to consume it.
Well, that's human nature, right? That's not the genre. That's human nature, and the genre appeals to it. Why, if we could say that the secret, that the promise is the ability to beat the market, why is it that when the market has returned such good returns for a long time that people are so obsessed with trying to beat it?
I think that's another of our sort of big questions that we were kind of really trying to answer. Because I think there's a real turning point in the post-war world by the time you get to sort of Burton Malkiel in particular with the Random Walk Down Wall Street. Yeah. He's the first to really popularize all the kind of scientific economic work that's been done on studying the market, efficient markets, and kind of the idea that you can't beat the market, that it's just an illusion, and the natural result of that is, passive investment, that if you can't beat them, just play the market, just kind of accept market returns. And he's one of the first big sellers to really promote this idea to a wide audience. But in the same time, his text is full of contradictions, you could say, because at the same time that he's dispelling all these ideas that you can beat the market with XYZ secrets, you can beat the market. He admits, like telling the average investor that you cannot beat the market is like telling a 6-year-old that Santa Claus doesn't exist. It takes the zing out of life. Yeah. That's what he says. So even he admits he's a proselytizer essentially for passive investing.
A proselytizer.
You want to hit that?
Yeah. Sorry. What in the world? I know I've got a good vocabulary. What is a proselytizer?
Sounds like a good time. I don't know.
I did wonder what that was for. Now I know.
It's the proselytizer button. Yeah.
It kind of has religious connotations, but it's kind of like to propagate for an idea, to kind of try and sell
like an
idea.
advocate of that.
Yeah, you're full of this religious intensity. You're going to share the word that this thing is magic. This thing is great. I need to share it. So you're kind of like a propagandist for an idea.
So he was out for passive investing.
All like the logic of all of his ideas, and that's a text that I think is still in print, is hugely influential. Discrediting a lot of the more active. He also came up with it. The idea of the blindfolded monkeys throwing darts at a board, and that they're going to pick better stocks than an expert fund manager. That kind of idea. But at the same time, he admits within the text itself, active investing is fun. Trying to beat the market is fun. And so some of the text is about that as well. So it's a kind of ambiguous sales pitch. So even the people that are kind of selling the idea of passive investment are also admitting that active investment comes with a lot of thrills. We're back to the idea of investment as fun, as exciting. It's a leisure activity. But it also, I think, wraps around to those ideas about manhood, masculinity, self-realization through the market. And I think that through the 20th century and into the present, you get that blurring of the genres between stock market advice and self-help.
Yeah, we spoke to someone yesterday, and they are a believer of active. They were skeptical of passive investing, especially market-weighted indexes where, you're essentially momentum investing, as she put. And what I found was, she was very honest. She said, I've been wrong about this for over a decade now in terms of active's going to make its moment, but active will have its moment now because interest rates are changing. And do you find that throughout time that people can be faced with evidence that says they're wrong and they still want to drink the Kool-Aid in that sense?
Yeah, it's an interesting one. I think the genre of stock market advice is very kind of durable. So in the face of crises, crashes, radical economic downturns and the rest of it, it survives. It never seems to get discredited. The advice can kind of accommodate almost being proven wrong because a lot of it places the onus on the individual investor. If you've lost money, then it's your fault. It was your fault.
Your emotions were wrong. You weren't man enough.
Yeah, exactly. There's all kinds of get outs there.
Yeah.
You didn't do it right. So it's a kind of, that placing all the responsibility on the individual. So the advice kind of just shifts, and particularly those years where there's such a big battle between technical and fundamental analysis, that it's very easy for them to kind of pass the buck and kind of point to others for, well, no, if you did that, you would have lost money, but if you followed us, you would have made money. So whatever crisis comes up, you can even see it in, when COVID came along, lots of opportunistic advisors kind of saying, well, we can help you make money out of this seemingly disastrous kind of health, but also economic crisis. So I think it's a genre that can kind of survive any sort of evidence that sort of proves it wrong in many ways, because all that basic appeal that appeals to our human nature is still in place. There's always the chance of, all right, this time it's different, particularly when it's attached to a new technology. Or
this time it's different.
This time it's different.
It never is.
It never is. Do you find when people start investing in the stock market that most people, like the majority of people, will be like, oh, I'm going to pick Apple, I'm going to pick Tesla, like they just pick random stocks? Or do you find that from your research, more and more people are going passive? Like I know when I started, I was just picking random stocks, not random ones, but ones that I thought were going to go to the moon or be up in the next year or so. Do you find many people are like, actually, look, let me just get it in an index and leave it and be passive? Or do most people start active, get burned, and then learn that you should probably be a bit more passive? Or
I think it's really is. I think a lot of people are turning to passive investing. I think it's bigger than ever before. And it's interesting how it's a keystone of a lot of the kind of FIRE advice and all of that movement. I think it's no coincidence that really took off in the years of a very, very prolonged bull market.
They're doing the same thing as well, aren't they? Promising the secrets to...
Maybe for people who don't know what this FIRE...
Financial independence, retire early. It's like, I can take you from a very normal job to being retired within a few years if you buy my book. But basically it's live off less than you earn and invest the rest, but take that to a hyper level. So if you could save 50% of whatever you bring in on an annual basis, you can retire quite quickly. And they provide a very basic calculation for that. And not a lot of it's based on like the Trinity study, the 4% rule, and it's just retiring quick. But it's been commoditized in a self-helpy way. So,
Yeah. And I think, it's good to the extent that it is publicizing a lot of good ideas around financial management and stuff like that. And it's good that it's promoting passive investment, perhaps rather than pick the stocks and get rich. It's not peddling a simple message in that sense. But at the same time, it's kind of all of the, it's very anecdotal and this is what I did, and sharing the secrets of what they did during a very long bull market. We're not sure if the next 10 years are going to look like the last 10 years.
A lot of them earn a lot of money.
A lot of them have...
they're computer programmers on 200 grand a year, so it's easy for them to save 100. But they say extreme frugality, anyone can get there, and they show them like the calculation. And I'm not normally a fan of New Year's resolutions.
Yeah, me neither.
But I genuinely hope that whatever goals people set, they hit them this year. Financially, I'm speaking, and that goes for you as well.
But Damon, how can you improve perfection?
There's so many things wrong with that statement, mate. But anyway, maybe you need professional help. I think you do. And that's where today's sponsor comes in, Unbiased.
Their platform with 27,000 independent financial advisors. So they can help me with my savings, investments, pensions, and also my mortgage stuff. Because, I want to buy a house.
Yeah, exactly. They match you up to an expert that meets your needs, and the first consultation is completely free. So if you'd like to speak to a financial advisor, head to unbiased.co.uk/making money. That way they know that you came from us, and there's a link in the description.
Back to the show. That's how you do it.
Yeah, that's how you do it. One thing I would say is, someone coming new to any area, you assume there's a level of expertise that you would need access to get into it. So if I was going to go into medicine, I wouldn't just walk into a hospital and go, you know what, I can possibly chop up anyone in here and I'll be fine. I think the doctors are probably quite skilled, but like within finance, it's almost the opposite of that. And I think probably why the literature is so persistent is because most people who know nothing think that you need to know a lot. Does it make sense what I'm saying? So it gives space for these pseudo experts to come forward and go, I'll be the teacher because it's really complicated over here. And if you do it wrong, you're screwed.
I think, it's hard to generalize. There's so many different kinds of advice out there, different kinds of providers. So there are some that are, stripping it down to essentials and saying, well, this is really easy. Anyone can do it. There are others who are mystifying a lot of it and kind of, I have all the secrets and for a fee, I will share them. So there's all kinds of different strategies for kind of establishing yourself in this market. But I think a lot of it is trading off the idea that, a lot of people grow up, they're not taught, financial literacy in schools particularly thoroughly. It doesn't really come up all that much. So a lot of people enter adulthood not knowing a lot of basic stuff. And so that creates a kind of big market for people who are honestly trying to help those people and spread financial literacy. But it also, of course, creates a lot of opportunities for those who are perhaps, have less honest aims and kind of peddling, get rich quick schemes, whatever they might look like. So
through the introduction of marketing into the space, so I'm one of these people that I can spread the information for free, people can consume it for free, and I can get paid. Do you feel that will change the landscape for this kind of, because these people, there's always a back intention there. There's always they want to sell something. They've got, there's like an ulterior motive. Whereas now, all you need is attention to earn money. You don't need to sell anything.
I think that's a good point. And it's, getting a historian to kind of make any prediction about the future is we're really bad at it.
Maybe people like you be studying me in 300 years ago and this guy called Damien. Yeah. Well, he was a dodgy motherfucker.
I think, it's still playing out, the kind of the power of the internet to change a lot of these equations. And I think one of the things is that financial advice, financial literacy education has never been more accessible. Yeah. And, there's a very good quality advice has never been more accessible. But I think it's a bit too early to say whether that is really going to change the picture long term, because it does take people to does take people's attention, does take people to follow those lessons, internalize them. And of course, it doesn't solve the broader kind of structural issues with the economy that, as we were kind of alluding to with maybe FIRE, that maybe some of that is less relevant to someone who's on minimum wage, is really struggling, is relying on a food bank. The idea that they can put a percentage of their weekly pay into an index fund is wishful thinking. So, I mean, financial advice can do a huge amount of good, but at the same time, it's not the solution to everything.
I think there's another conversation that people might not realize that happens is people talk about things because they get views. You talk about a particular stock because it's a popular stock. It doesn't mean it's a good investment, but you get more views. Yeah. And the views are money. They are literally, it's like you're mining oil out the ground. You get the views, you earn ad revenue. So people in my space are incentivized to talk about certain topics solely for that reason. And they're also incentivized to lean towards the negative because that will get them more clicks. And we can see that in the data. So we have click-through rate, which is what percentage of the people who've seen this thumbnail have clicked. And if I pull a shocked face, that will be 2% higher than if I pull a normal face, a happy face. So the incentives now to lean negative, to lean towards popular topics will mean that the people who are influencing the market are being influenced by the market. And then you get a point where Tesla is the most bought retail stock on the planet and is by all metrics massively overvalued, because it's everyone's thinking, well, if all the experts are talking about it, it must be good. But they're only doing it because people watching it because they want to hear that people think it's good.
It's kind of called performativity, the academic term. Don't press the buzzer.
You call me performativity.
But it's kind of, which is just a fancy term for sort of saying self-fulfilling prophecy. So a lot of these, and again, this goes back to print advisors and journalists know that if they talk about a particular stock, if they hype a particular stock, it's going to move the market. So it becomes a self-fulfilling prophecy. And there's evidence that this goes way back into the 19th century where they're aware of that power. And so it's not quite the same as what you're saying, but it's kind of an awareness that, okay, so what I talk about might move the market in a particular way. And so the huge scale of Tesla now, it's funded by that kind of loop. It's difficult to see how that's going to be broken because the more people are talking about it, the more hits, the more people are going to buy that stock, and what will ever break that cycle.
It's kind of mad. It's crazy to me how everything you've described, you could have just been talking about YouTube right now and nothing has changed in the 300 years.
I think, it's to some extent that's true. I think, and we're always fascinated when we see those echoes, those parallels, those early examples. I think certain things have changed, but it's more of a kind of development of seeds that we can see in the kind of 18th, 19th century. The scale is completely different. The kind of blurring of the boundaries between sort of stock market advice literature and self-help literature, those two things have blended in really interesting and complex ways. And that's kind of quite new, even if we're tracing the seeds of that back a long way. As historians, we're always looking for precedents and early examples. But there is a kind of change. I think if we're looking for things that have changed, because that's interesting as well, is this kind of what's often called the financialization of everyday life, and how the financial is so embedded in people's sort of personal life, everyday life, family life. To view yourself as an investment.
The best investment you can make is in yourself.
Exactly,
this is very popular now.
And kind of maximizing yourself financially, looking at your asset streams. How can I maximize my asset streams and my family's asset streams? And it's financializing every aspect of your daily life and your family life, encouraging that sort of blurring of boundaries.
As an expert over the last 300 years of the stock market, do you invest yourself?
Well, it's interesting. For a long time, I didn't really, having no sort of, I wasn't brought up in a family that invested. The stock market to me was something that I engaged with very much historically. I was fascinated by it historically. But there's a kind of that idea almost of object distance. You want to retain your objectivity to it. You don't want to be invested yourself emotionally and financially. You just want to study it historically. So for a long time, particularly as I was studying the history of fraud for so many years, and that was kind of,
I don't want to do that.
It kind of, it colours your views a little bit. But kind of perhaps beginning to look more at the historic evolution of passive investing and that kind of thing, and the key texts of that, I found myself being influenced by that, discussions with my co-authors and others that we got involved in the project. And kind of, so it was a learning experience for me to kind of connect up what I'd always been interested in historically with what I might do with my own money. So it was through this process that I began passive investing, not stock picking.
This process got me passively investing instead of, I was definitely stock picking and crypto picking and just picking whatever I thought was going to make money. But this journey has been that. Now I'm a big fan of passive investing.
This is why I hope I'm a net positive in the financial niche or whatever. But do you think the overall genre itself is a positive influence?
I'd say it's so much of a mixed picture. I'd say it's hard to kind of say as a whole it's been positive, because there's so many kind of cases of fraud, of interested advice, of kind of selling the wrong kind of message and selling fake hope in many ways. So I think it's a mixed picture.
They call it.
Yeah, exactly. Yeah. So I think there's so many examples where it's not ended well for people. It's given people false hope. Just playing to this idea that you can get rich, you can succeed without really trying, without really making an effort. So I think there is, we can trace back, good advice, sensible messages, things that have helped people through the centuries, definitely. But, riddled throughout the genre, all these kind of false hopes and things that are delusive, that are leading people down blind alleys. And even with the kind of message of, passive investment being a good thing, even that can be kind of perhaps oversold as being the solution to all of your problems. The market only ever goes up. And it's kind of, well, if we look since 2009 and, the 2020 blip, it's been on a very upward curve, and all the people who've made money out of passive investment in that period, great for them. Their timing was perfect. But, can we really say the next 10, 15 years are going to be like that? So I think sometimes it's slightly oversold as this is a surefire way to make guaranteed money. So even something that is as sensible, I think there's so much evidence to say that it is sensible. It's a good thing to do to try and beat inflation, that even passive investment can be oversold or given with too much of a kind of promise that you cannot lose. Well,
I've been guilty of that. And I would say that the way that maybe passive investing was, I over-internalized it as a positive, was I'm unhappy in my job. I don't know what I want to do with my life. Oh, here's this passive investment. That's the thing that like one day will set me free. Whereas actually what you're committing to there is 30 years of being miserable. Do you know what I mean? Like it's not the answer in that sense. It's not the answer to your deep like unhappiness or just like frustration at your own situation. You might not like your job. Passive index fund investing isn't going to make that go away, you know, but that I found when I found it, I was like, oh, here it is. Here's the answer. Yeah. I'll be happy in 30 years. Do you know what I mean? And luckily it's led me to a position in a career where I am happy through talking about it. And I think it's like a routine, like having a shower every day. Do you know what I mean? Like you should do it because it's good for you, like you say, from inflation, but it's not going to fix your life.
Yeah, and that's a kind of, if that's the message and people understand that and people are happy to kind of plan for a long-term economic future through that, then that's great. I think that's a positive thing, but it's kind of, there's still emotions attached to passive investing. And I think a lot of people who bought in at the wrong time to put their money in having been told, well, the stock market only ever goes up. Look at my graph. This is what happened to my money when I put in 2010 or whatever it might be. It's, you know, there are risks, there are emotions involved that you log into your account and you see, oh, I was up yesterday and I'm down today. And kind of, there's still a kind of emotional side to it. It's not going to solve all your problems. And I think because there's not quite that kind of instant payoff, that's what drives people still back to stock picking. There's always that appeal of, look, I'm 100% up today.
Yeah. Yeah, so
that's exciting. That's fun.
Yeah,
that's thrilling.
Yeah, and would you say then, you know, if you were advising someone that was going into this world of active literature, like financial advice literature, would you say then that's what you should need to look out for? The people that are promising the quick returns, all the things that people would say, you know, get rich quick and I've got the answer. Is this the kind of literature that you would try and put to one side?
I think, yeah, it's partly that. I think just, you know, stopping for a moment and evaluating who's giving the advice, what are their credentials, why are they giving me this advice? Those kinds of questions should be there. But as well, think about your own motivation and what you're trying to get out of it. If it's long-term economic planning, you know, thinking about your financial future, thinking 30 years down the line, and if you've got money you can put aside every month, and passive investing might well be the thing to do. But if you're after a thrill, if you want that excitement, then stock picking might be the answer, but realize that it's a gamble. Realize that you're not going to beat the market. You know, 99% of day traders don't beat the market. I think that's the stats of one of the major studies. Yeah. And, you know, increasingly you're competing against algorithms in terms of your trading. So you might have access to all the latest market data on your phone, on your computer, but you know, the idea of beating the market is such a seductive one. But if you're getting into it because of that thrill, that sense of self-mastery, that sense of self-realization through beating the market, through seeing into the future, then maybe you shouldn't be doing it because they're the wrong kind of payoffs to be chasing. And that's where people can get into trouble, I think, if they're pursuing the excitement, the thrill, the self-gratification. You know, because when you pick something, it comes off, you make a big profit. It's, you know, that power of I can see into the future. It's an economic payoff, but it's a non-economic payoff as well, and people can get hooked on that. I think it's very addictive. And if that's your thing, fine, but you know, bet what you can afford to lose because it is a bet. It's not an investment.
How I feel every day.
Well, the single biggest event that brought more people to the market than anything was like GameStop. I saw within my channel, like I could stand there banging a drum going, you'll get 9% a year every year on average, and that'll fluctuate. And if you do that for 30 years, look at how much money you got. And people are like, nah, forget that. Mm-hmm. But this like, you know, short squeeze over here on a nearly bankrupt company, that I'm throwing all my money into that. So it was like those emotions, those powers are powerful.
So people who are, disenfranchised, people who feel excluded, you know, all those kind of non-financial payoffs. There's, you know, it isn't just that they're in it to make money. It's all the kind of political, you know, it's revenge for the crash of 2008 as well. It's kind of, sticking it to the hedge funds. But those kinds of motivations, we can trace that back and seeing, you know, other outlets, other brokerages that have sold the same kind of idea. It's a message of populism, which probably isn't going to go away.
And you've seen that repeat throughout history at key times.
Yeah, it's kind of really the origins of that one, not necessarily 300 years, but late 19th century with these outside brokerages, bucket shops, the language of that is very overtly populist and kind of very down on the stock exchange inside elites. And it's particularly strong in America, where their politics are developing in interesting ways with, you know, growing concerns about the power of elites. And so these brokerages were really pushing this democratic populist kind of language that tied in with the politics of the time. You know, we're standing up for the small man, the small guy.
Like, say 2008 might have been similar. People really turned on financial markets. People thought, you're the reason that we're like this. You know, you've ruined everything, basically. How does the literature navigate those periods?
Well, yeah, you would think with huge difficulty, but it's weird how they just kind of skate along the surface of it. You can highlight a few, you know, overt cases where so-called experts, you know, are making big statements in the autumn of 29, just before the crash, saying, you know, things are going to go up now, is a great time to invest, you know, like literally weeks before the crash. So it's kind of harder for people who've really stuck their neck out. But in the broader kind of genre of financial stock market advice flourishes through those years. Admittedly, there's a smaller market. A lot of people have lost a lot of money. So the stock market does shrink. It doesn't regain its post or pre-1929 levels until the 1950s. But the genre keeps going, and that's when you get the real flourishing of fundamental analysis.
Is it that because their style failed us? They were wrong, we've got the answer now? Is it that?
It's kind of, a lot of it is, yeah, it's slightly more difficult for the technical analysts, the chartists, to kind of get their way out of it, although they do. But in post-29 regulatory climate, where you get more and more data becoming available because of disclosure requirements being placed on corporations for the first time, much more extensive. So much more data, and that really feeds into the growing trend of fundamental analysis, value investing, because you can crunch the numbers yourself now. All this data, which was private, is now publicly available. So that really provides a big boom to fundamental analysis, and the idea that, well, we didn't have all these skills and all this knowledge before 29, but now we do. So, you know, again, this time it's different. We can approach investment in a much more scientific way. We won't get burned like people did in 29.
It's a very convincing message, isn't it? So we've got the science now. They didn't before.
Exactly, yeah. So there's always an angle. There's always a way, despite, you know, 1929 was huge. You know, like the market loses, was it 89% of its value between 1929 and 32? You know, it's huge losses.
That's a dip. I lost that last year in crypto. It was about 80% dip drop. Yeah, but yeah, that's crazy. Man, you've got like so much money in there, and it just.
Oh yeah.
And it's over how many years? Two or 3 years?
About 3 years. Yeah.
So was it on average per year like 25%, or how did it?
It absolutely tanked.
It just tanked.
There was some like traps in there as well. I think it rose, like dead cat bounces as they call them, and like people threw their money back in. And there was, even when it was dying, people were like, it's going to come back. And people caught falling knives and all those sorts of terms.
It's just, people got into, you know, like 1930 saying, well, that was bad, but now's the time to buy. And then they're the ones who lost
another step down.
Yeah.
Have you, throughout your 300 years of research, have you ever seen anyone that's got the answer? Where you're like, this guy probably had it nailed. Like,
it's a good question. It's tempting to say yes, but I mean, a lot of people have got a bit of the answer, but in kind of like trying to find the perfect solution, like the Holy Grail, it's probably a myth. It's probably, you know, that we're never going to find the surefire route to riches, but it's the quest for that. The quest for someone who figures it all out is kind of, that's what keeps, you know, people investing, keeps people reading. You know, whether it's the manuals, which still exist, they're still flourishing as a, you know, genre. The internet hasn't killed them, but obviously the internet has increased the number of platforms. So it's still going. But if there is a holy grail, then it's kind of, you know, passive investment. That's the closest we've come to kind of, you know, figuring out, well, we can't beat the market, but maybe we don't have to.
If you enjoyed today's episode, you'll love this one.
And if you want a summary of everything that we've discussed, then sign up to our newsletter in the description below. And don't forget to subscribe here.